It is 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. Apple loses nearly $200 billion in market value just days ahead of its next iPhone launch. The high-stakes event risks being overshadowed by multiple controversies in China. The dollar snaps its winning streak as investors focus on dovish comments from Federal Reserve officials. New York Fed President John Williams tells Bloomberg policy is in a good place. And Goldman Sachs is said to be moving to fire underperformers as soon as next month, bringing an end to its pandemic freeze on job cuts. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in for Danny Berger in London with Sonali Basak in New York. And Sonali, we started the European session on hopes that maybe we would snap 7 days of losses, but the sentiment has again turned negative.
Same here in the United States. When we're looking at the S&P, we're looking at another day of losses, down about 0.2%. This is the Friday ending a week of losses. After a week of gains here over in the United States for the S&P 500, we're finally looking at some cooling, though, of the two-year yield. We're looking at a 493 handle. This earlier in the week had surpassed 5%. And so this cooling is about flat today. But again, we have come down from the highs of this week. Now, again, with the cooling of yields comes the cooling of the dollar. This has been defying gravity all week long, really pushing global markets into new territory here and historic levels in some Asian currencies as well relative to the U.S. dollar. Finally, some cooling into the weekend here on some dovish comments, as you've been saying, from Federal Reserve officials. But we do have CPI next week, so a lot more where that came from, Tom. We're also looking at Brent crude earlier this week, surpassing 90, ending the week now looking at an 89.75 handle. This is about 0.2% lower on the day.
Yeah, well, energy is obviously consequential for Europe as well. So we factor that in as we look at the European benchmark. European stock 600 down by 0.5%. But again, I will remind you that at the start of the session, we were seeing some upside for European stocks. Now turning lower, of course. So it looks like, at least from now, we are set for 8 straight days of losses. Still early days, of course, in the European session, but potentially straight days of losses for European stocks. Euro, dollar, the single currency is getting a little bit of a lift this morning, up 0.1% at 107. We look ahead, of course, to that really important meeting from the ECB, September the 14th, and a Bloomberg survey just pointing out the split nature of the views amongst economists as to whether or not they hike or go for a hawkish pause. Natural gas, you talked about oil, the natural gas story is in focus for us as well, given the strike action in Australia accounting for potentially 7% of global energy coming out of that nation. Strike action there linking to the workers who work for Chevron. That price now up close to 7%. And of course, we think about the winter months in Europe. Stockpiles, though, and inventories remain relatively high in Europe.
Now, we're keeping an eye on Apple shares. Big story of the week as the company looks to stave off a crisis in China just days before the launch of its next iPhone. Joining us now is Bloomberg's Alex Webb. Alex, when you look at the issues that Apple is facing in China, how much is their business at risk in the country?
Well, there are two pieces to this. On the one hand, there's what we know. It's been reported from our colleagues from sources, namely that China is cracking down on the use of iPhones in state-owned ministries, but also enterprises, companies like PetroChina, who between them employ millions of people in China. Now, that in and of itself is not all that significant for Apple's sales. There are some estimates that it sells in the order of 45 million units a year in China. Significantly less, maybe 500,000 would be at risk from this. The bigger question, therefore, is there something about the mood music? There are times in the past when there's been a sort of resurgence of nationalism when it comes to purchasing, and that is around the fringes hurt Apple's sales in the region. Is that going to be the case then with the next iPhone cycle? That seems to be the bigger fear that may be informing some of these stock declines. Yeah, and it's a reminder that they can send Tim Cook over there to kind of kiss the ring, but it's not necessarily going to put an insurance around Apple forever when it comes to national security concerns. One caveat to that, of course, is that, they are symbiotic. Apple employs millions of people indirectly in China, so it does need Apple to an extent as well. OK, just very briefly on the Huawei investigation around the SMIC chip by the US. Yeah, so the US is looking into this chip, which is in the brand new Huawei phone. There's a suspicion that maybe some sanctions were breached in order to make it. SMIC, which is the Chinese contract semiconductor manufacturer, makes them under the designs of other people. The fact that they've been able to make this pretty high, bleeding edge chip, not the latest generation, but close to it, has been a surprise. So the US is now looking to see if something untoward happen to make it happen.
OK, Alex Wigg, there's finger on the pulse for all things Apple and the consequences in terms of their exposure to China. Thank you. Now, we're also, of course, watching the Yuan as we talk about China as the PBOC set its weakest fixing in 2 months. Bloomberg's Valerie Teitel joins us with the latest. Valerie, there's been a bit of a turnaround for the Yuan. And what does this tell us about the sentiment of the PBOC? Are they expecting now, are we seeing them moving some obstacles out of the way for further downside as they look maybe to the export engine of China?
Well, look, Tom, that PBOC fix overnight was the first time they have set it above the 720 handle since June and is possibly raising questions that they might let this currency slide more. They have been quite unsuccessful in stabilizing this managed currency this week. We have seen CNY weaken by 1% just this week, and the offshore yuan is nearing all-time record lows since its creation in 2010, and just overnight, even the onshore currency hit a fresh 16-year low. So a bit unsuccessful in the PBOC stabilizing the currency. It is causing some other problems that we want to keep an eye on, Tom. Note that this currency invention is effectively taking yuan out of the financial system, and it is causing some liquidity issues. It's been exerting pressure on funding costs, and yields on short-term rate instruments in China have seen their biggest one-day move this year. We should also note that the PBOC hasn't just been manipulating in the spot market. They've also been manipulating in the forward market, trying to make it more punitive for speculators to short their currency.
Now, over in the United States as well, we have to look ahead because investors are expecting Fed officials to hold rates steady when they meet later this month, with policymakers having a fresh inflation data print to review before then. We spoke exclusively with New York Fed President John Williams yesterday.
Right now, I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments and assess what we need to do.
Valerie, how does all of this set us up for next week?
Look, there were no major bombshells from Fed officials this week, most of them mirroring various comments that Powell even made at Jackson Hole, saying the need to proceed carefully with hikes, that they don't see any need for any imminent action. All of this points to the fact that the Fed will likely go on hold in the meeting in 2 weeks' time. It is important to note, though, we did get some information on wages yesterday from two sources. We had the Wall Street Journal reporting that Walmart is now reducing wages for new employees. And as this chart here on TV shows, the Atlanta Fed wage growth tracker is showing more moderation in the wages in the U.S. We've actually seen them now cooling to a 2-year low. So all that progress on wage inflation, even though the labor market arguably still stays very tight, is good news for the Fed. And we have seen the front end rally a bit after this news, with now positions raising an eyebrow to whether the Fed will actually need to go and hike when it comes to their November meeting.
OK, Bloomberg's Valerie Teitel, thank you. Let's get to what's happening then in terms of the fate of Goldman Sachs. According to the Financial Times, Goldman Sachs plans to dismiss underperformers as soon as next month. That's as part of the Wall Street firm's annual evaluation of staff. Goldman managers have started drafting lists of those who may be cut, and the final numbers are still being set. Shonali, you followed this story very closely indeed. On one level, this isn't a big surprise, as of course you know. They're resorting to a method of cutting headcount that they used to put in place pre-pandemic. But it is also significant in terms of the timing, and of course we wait for the numbers.
On one hand, it's also feeling very early. It's only September. But on the other hand, it also provides some certainty, doesn't it, Tom? They have cut thousands of jobs. It has been a tough year. You're watching a year where Goldman Sachs and other banks also are facing their returns on equity under pressure. We are weeks away from a third quarter print. They have made massive changes to their consumer business, and this looks like a lot of housekeeping coming early to start 2024 quite fresh, isn't it? The number of jobs is about 400 or so. These cuts come annually, not just for Goldman Sachs, but also for its rival banks. And this is a wake-up call not only for Goldman bankers, but also for its rivals, isn't it?
And Shonali, we've had David Solomon, the CEO, of course, coming out and trying to defend his character and push back against what he describes as some attacks in the press. What do you make of the focus on the CEO?
there is intense focus on the CEO, but at the end of the day, this is a matter of performance, isn't it? Which is why I bring up that third quarter print. If we think about it, if they can show some clean numbers here in their third quarter, we can look at him coming out quite cleanly, can't we? It's at the end of the day what the investors and the board want to do, and it comes down to what the numbers shape up as.
Yeah, so I mean, the message from the comms team and others is, look, these are partners who are kind of aggrieved because they haven't had the bonuses and the kind of comp they may have been expecting. Also worth noting, of course, over 5 years, Goldman has performed pretty well. Under his tenure, up about 50%, even slightly better than JP Morgan. What do you think? What are the next things to watch? You've got the next set of results. How much progress is made on the retail business? Because that has been a misstep, at least in the view of many.
Well, on one hand, you have them selling off their Marcus loans. You have them starting to get rid of some of the businesses. They're very close to be having a green sky sale. I'm sure they want to get that off their books by the time they are reporting, if not nearly after. They also have that sale of that United Capital business, which is going to come in at a gain relative to a loss, as we've seen with that green sky write-down that they've already taken. So there is a chance the worst is over. If there's a little more messiness, they do have to explain it. Tom, there's a little bit of a silver lining here for Goldman Sachs, and it's the return of deals. They are, I believe, 40% of the IPO market lead left underwriting here. It's a very significant share, so they might be able to point to deals coming back should this market hold up. But that's also a question of the markets, let alone performance.
Yeah, OK, so we watch that deal flow and wonder whether or not what we see from ARM is going to lift sentiment in terms of listings, at least in IPOs. Shanali, of course, few better placed to talk Goldman Sachs. Coming up later this hour, a growing risk of overextended levels for tech stocks. That is the view from abrdn's Luke Hickmore. More with him later this hour. And President Biden heading to India for the G20 Summit. The key issues then on the agenda. President Xi will not be there, neither will Putin. But we've been hearing from Treasury Secretary Janet Yellen. Plenty more from the G20. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. We want to bring you to the bond market because we were watching record corporate bond issuance earlier this week on Tuesday. Just take a look at how much more was issued in bond markets. This is the relative calm you're seeing in the market, as well as a market that has been trying to get ahead of a CPI print that could really change the calculus on the direction of U.S. interest rates, at least according to what the market believes. Now, this is all in the United States, and this investment-grade issuance can pave the way for leveraged borrowers, for riskier borrowers, and those are the borrowers that we have seen drop off the market pretty significantly this year. And joining us now to talk more about this issuance, can it continue, is Dana Al-Baltaji. She's Bloomberg Managing Editor for Credit. Dana, when you take a look at this issuance, you've got to ask, can it continue?
I ask exactly the same thing. And you know what that tells me? That tells me that issuers have learned that when you can sell bonds, do it. Do it as fast as you can. Do it so long as the market can take it and sell as much as possible, because we have seen that there are periods when the market absolutely cannot absorb that amount of debt. So I'm not surprised at all to see that issuers are trying to take advantage of this. And I'm also not surprised to see that leveraged borrowers are trying to tap the market, more so in the US, obviously, because the market has not been as shut in Europe as in Europe, where we had seen like a long dearth of junk debt. But it's very important to note, though, even when we are looking at junk debt issuers tapping the market, it's still the best of the best. So we're not looking at very low rated junk borrowers. It's mostly highly rated.
Dana, is this issuance coming across the board, or is it particularly focused in one area? And what has demand been like?
So demand has been really significant, mostly because you've got a lot of investors that had been waiting for this, so they've budgeted for this flood of sales. But because it's September, and September is one of the 2 months where you usually do have a flood, we're seeing issuers of all kinds. This is not just one particular sector. It's all sectors. So we're looking at pharmaceuticals, we're looking at banks, we're looking at all kinds of issuers here.
What about the risk appetite? If you think about these leverage borrowers looking to re-enter the market, is there demand for it, or are there still worries about losses here, given that default rates are starting to tick higher?
This is exactly the big uncertainty that we're facing in the market, because if you believe that a recession is coming, then obviously you think that there's going to be a massive risk if you buy into these riskier bonds. So the big question is, how do you price the risk of recession when you know that rates might be peaking? And this is all part of the game. At this point right now, we're seeing that the cost of hedging has been fairly stable. We are within that new normal range, and people are quite comfortable with the fact that there could be some risks, but they've also learned that they cannot forecast too far in advance. So they're buying what they can right now at what they think is a reasonable price for the market right now. And that's as far as they can take it.
Now, really quickly here, Dana, CPI next week, how much can this throw things off course?
I think actually it could potentially be an interesting driver for markets, because if CPI is weaker than expected, then of course that narrative of rates being higher for longer, as well as whether or not there's going to be a rate increase, really starts to play into people's expectations of whether or not borrowing costs are going to fall and whether or not the price is right for these bonds. Again, you know what? It's so hard to know where that CPI number is going to hit. So at this point, that's one of the reasons why you saw all of these issuers hitting the markets now.
Dana Al-Baltaji, we thank you so much for your time. Now, Australian LNG workers at key Chevron sites began partial strikes today after failing to reach an agreement in a dispute that's roiled global gas markets. Joining us now is Bloomberg MLive editor Eddie van der Walt. You have been watching energy markets across the globe all week. What does this mean?
Yeah, this is definitely one to keep an eye on, right? People will remember that last year, European natural gas markets were under real pressure when, there was a disruption to Russian flows. Now, Australian gas usually doesn't make its way all the way to Europe. The Australian gas usually supplies the hub around them, right? It usually goes more to China and to Japan and so on. But this could have knock-on implications later in the winter. European natural gas, at the moment, inventories are very full. We're talking about above 90%. But you need a constant stream of LNG to keep that supplies going, particularly if you have a cold winter. So I think for me, the focus turns to the later contracts, the ones around about February maturity, because I think at later in the winter, we'll see whether we have enough gas. If these strikes are rolling, if they continue, they could really be an issue.
Eddie, at a time when we're focused on gas and, of course, higher oil getting to that $90 a barrel level, kind of reminds us of our continued use of these carbon-heavy energy inputs and then the climate impact. And we're seeing that in Hong Kong today with some remarkable images.
Yeah, absolutely. So we had Hong Kong markets brought to a standstill. They had to be closed because of heavy rainfall. And I think these climate events, as you point out, they're becoming a real focus point for markets. And I think this really brought that home to traders that, so you're not always going to see the New York Stock Exchange or whatever close down as a result of rain, but it's going to impact markets, right? It's going to impact demand. It's going to impact how people trade, and it's going to impact, this kind of flooding that we saw there will impact markets, whether it is commodities like grain or wheat or whatever. You're going to see those impacts, and that's going to impact prices. And I think this is a wake-up call for traders.
Yeah, it's the second Friday in a row that Hong Kong markets have been closed. One was forecast, the typhoon of last Friday. This was not forecast, and it came as a big surprise, of course, for the markets there and people living in that city. Eddie van der Walt, thank you very much indeed from the Bloomberg MLive team. Coming up, Softbank's ARM looking at a 20% sales growth in 2024, boosted by AI. More on that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Shonali Basak in New York.
Now to some of the top stories we're watching this morning. ARM reportedly said on its investor roadshow that it expects revenue growth of more than 20% next year, boosted by demand for chips to power data centers and artificial intelligence. The Softbank-owned chip designer is looking to raise as much as $4.87 billion in what's supposed to be the largest IPO of the year, but of course, downsized from the initial expectations. Landing ARM's giant IPO is a coup for Mizuho, one of the 4 global investment banks leading this year's biggest deal. Now, the Japanese firm needs to prove that it's just one more thing than a one-time thing. What's fascinating about this, Tom, is not just the coup for Mizuho, of course, such a large bank in Japan, but the global reach that Mizuho is trying to make after buying an investment bank of its own under the leadership of Michal Katz at that corporate investment bank, hiring bankers from across Wall Street.
Right, so third largest bank in Japan, but a coup as they try and make moves and carve out more market share, of course, in the US. And yeah, partly it's about a relationship that goes way back about 40 plus years with Masayoshi Son, but it's also, as you say, about that leader of the US part of that bank, right?
Yeah, and it's very exciting and very interesting because a lot is riding here. Michal Katz is very much involved in the deal itself. From what I know about her and her team, she is often very involved in a lot of the deals, and they have been very much at the forefront of a lot of interesting financings as well. Will be interesting to watch.
Yeah, and we're hearing, of course, Rene Haas with those views in terms of revenues coming through for ARM, about 11% the current fiscal year, looking to 20% by 2024, 2025. With that focus, they want to shift away from smartphones and the arguably vulnerability there to data centers and AI, and the AI component still remains an open question for ARM. Coming up, we're going to speak to Luke Hickmore, talking from ARM to broader tech, investment director at Aberdeen, whether he thinks the tech rally has run out of steam. Stay with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here is what you need to know. Apple loses nearly $200 billion in market value just days ahead of its next iPhone launch. The high-stakes event risks being overshadowed by multiple controversies in China. The dollar snaps its winning streak as investors focus on dovish comments from Federal Reserve officials, with New York Fed President John Williams telling Bloomberg that policy is in a good place. And Goldman Sachs is said to be moving to fire underperformers as soon as next month, bringing an end to its pandemic freeze on job cuts. I'm Shonali Basak in New York with Tom McKenzie stepping in for Danny Berger in London. Tom, tell us what the markets are doing over in Europe.
Yeah, Shonali, the early optimism, at least modest optimism that came through for European equities after 7 straight days of losses, well, that has evaporated. You're seeing downside of around 0.6% across the European benchmark. So as things stand, we're looking set for 8 straight days of losses for European stocks. That is a stretch that we have not seen for many a year. Euro dollar at 107. Not a lot of movement right now. We continue to focus on that all-important ECB decision, September the 14th, with a Bloomberg survey just showing how split economists are, whether they go for a hike or a hawkish pause. Gas, energy prices, all of that, of course, feeding into the views around inflation longer term. And today, the focus on those supply constraints out of Australia. A strike is now happening there. And of course, those facilities in Australia providing up to about 7% of global LNG supply. That is pushing up prices close to 10%, 9.4% so far in the session. We continue to watch Dutch natural gas. Shonali.
Meanwhile, over here in the United States, we have another day of softness in S&P futures. This has been a tough week for the S&P 500 after a short week here after the Labor Day holiday in New York and the United States. Remember, though, we are watching a bid in bonds. We are watching the 2-year yield hang out at a 4.93 handle. We are watching it cool by about 1 basis point today. This was at about 5% earlier in the week, but we have some critical data coming up in the United States ahead next week, Tom. The Bloomberg U.S. dollar index cooling by about 0.1%, a big deal after a meteoric rise this week relative to currencies around the world. And you're watching Brent crude now fall below 90, where it hit earlier in this week. You are watching it down less than 0.1%. But the plateauing of Brent crude is certainly a calm in the market that has been pretty turbulent this week.
Yeah, a little bit of calm, at least in the session so far. And we continue, of course, to listen in to the official commentary coming through from Fed officials. And New York Fed President John Williams says U.S. monetary policy is, in fact, in a good place, but officials will need to pass the data to decide on how to proceed on rates. He spoke to Bloomberg exclusively yesterday.
We'll have to keep watching the data, carefully analyzing all of that, and really asking ourselves the question, is this sufficiently restrictive? Do we need to maybe raise rates again to make sure that we're keeping that steady progress in terms of getting imbalances, shrink imbalances in the labor market and bring inflation back down?
Okay, very pleased to say, bringing in this morning, this Friday, Luke Hickmore, Investment Director at Aberdeen. Luke, do you position for a pause from the Fed?
Yes, for sure, in September. And they'll be delighted to get through September into the October break where we don't get a Fed meeting. And then November, we will see. And that's when they will have been passing all of this data, looking at how actually the soft landing narrative is in there. The data has been okay. Few things, I think, possibly fly in the ointment for a November hike. That labour market data that we've seen recently has just been cooling off. We're seeing some individual company data as well that suggests hiring is also cooling off. Could be interesting. Could be September skip turns into a skip for the rest of the year. At the moment, I think I'm a November hike, but it could easily be no change. This is it. We could be at the plateau.
Could be at the plateau. I see your shoulders rising as you put some caveats around that potential for November to come through. What do you make of the action in the bond markets, Luke, this week? There's been choppiness, to say the least. I guess maybe a consequence of that data dependency versus the forward guidance. Where do you stand on how the yield curve adjusts in the weeks ahead?
What we've seen every time rates have gone up, especially when they've gone up sharply, is that 10-year yield ends up where the base rate is. So, that feels there's a little bit more there to go. But if the market starts really believing, as we do, that you get a long pause in interest rates, the curve will steepen up to get to that level of the 10-year, which for me means, you want to be in the front end of the curve. 5-year and 2-year duration work really well as we get towards this peak or at the peak. We could see those remaining being the best places to be over the next 1 or 2 years, possibly.
Luke, how much does the economic data next week, particularly the inflation print, matter to the narrative of rates? We have seen just such incredible volatility the last couple of weeks. Even this week doesn't mean a lot to see what we see next week.
So the way to play CPI over the last year is to be to sell duration into every CPI print. Because even when it's been coming down, it's perhaps not been as quickly as people expected, or it's been as broad as we wanted it to be. And you've seen impacts coming through housing in particular. This time, I think probably want to be maybe a little bit long going into the CPI print. I think the continuation of the drop feels the most likely scenario in terms of inflation. But this is not going to be the last of the inflation worries that the market's going to have to face. We are going to get waves of inflation for the next 2 years. Stratigas did a brilliant report on this just a couple of weeks ago. When inflation rises so quick and then comes off, we get waves of it going on. So be long duration now, be at the front end of the curves, be into steepeners, but that vol, I'm afraid, is probably going to be with us for a while.
How significant is the reduction in risk appetite in markets? You saw it reflected in equities this week, but at what point does it also become reflected in the bond market that is facing the brink of fresh issuance?
Yes, and we're seeing a big issuance profile from the corporate side for sure. We know the sovereigns have got a lot to do, whichever country you're talking about in the world, but let's think US, the amount of issuance coming along to cover front-end maturities where they've been borrowing in really short-term markets is huge over the next couple of years. So that's going to be a weigh on the market for sure. But generally, you find it's that broader economic picture which will drive your medium-term view rather than your short-term view, rather than supply. And I think that's the thing to keep in mind. We are at or near the top of rates. They will come down, avoid the 10-year. But supply is going to, it'll feed into that volatility that we're going to see anyway.
Luke, do you continue then within that environment to recycle out of equities and into investment grade?
Yes, I think so. And that's not an easy trade either, Tom, is it? It's not like investment grade is super cheap. It's probably fair value. If you look back over the last 20 years, we're fair value. But equities with the NASDAQ in particular, I think Apple's been fascinating the last day or so. but NASDAQ in particular, 1 year and 2 year forward, is trading in the 22, 21 kind of area in terms of PE. That should be in the 15s at this point of the cycle. So it feels rich. It feels set up for a problem to come along, shock the market. Maybe it's about the Fed getting aggressive again, who knows? But it does feel this time of year, seasonality is not your friend in equity markets, especially when pricing is where it is.
Look, on Apple, do you think it marks a turn then in these tech markets, or the tech-focused part of the market? I mean, one way to look at it is short term, at least tactically, this is a great buying opportunity, even if strategically, long term, you're concerned about the exposure that company has to China.
I really struggle with Apple. I'm a anything but Apple consumer. I'm very much in the Google mindset for all of that. But as a company, you may be right, Tom. And, you know, a lot of these tech companies are essentially long duration assets. If we get to the point of being 6 months into a pause for rates and duration starts performing, you should see the tech shares come back too. But they need to change in terms of their PE going forward. That 1 year, 2 year forward numbers are just too rich to get longer again right now. Now, Apple may be the lead towards the rest of the market repricing into a more reasonable valuation metric. And in which case, yes, you could be buying Apple, but I suspect they're not going to go down on their own.
Luke, we'll have to fly to London and steal your BlackBerry. Luke Hickmore of abrdn, thank you so very much for your time. Coming up, now world leaders are gathering in India for this year's G20 Summit. We're live in New Delhi next. This is Bloomberg.
So see China's growth as slowing over time. That said, China has quite a bit of policy space to address these challenges. So we're monitoring the situation. I don't see it as having very significant direct impact on the United States.
US Treasury Secretary Janet Yellen speaking earlier today as global leaders begin to descend on New Delhi. Joining us now is Bloomberg's Menka Doshi in New Delhi. Menka, what is on the agenda then, and what are the implications of Xi Jinping not being on the ground, along with, of course, Vladimir Putin?
Well, as Secretary Yellen pointed out, China growth is on the agenda, as is food security, supply chain revitalization, the reform of multilateral development banks like the World Bank, climate change and transition finance. I could go on. It's a long list. We're just on the day -1, if I can put it, because the summit officially begins tomorrow. And in the past few hours, we have seen world leaders arrive here in Mumbai. British Prime Minister Rishi Sunak, just moments ago, the Japanese Prime Minister also landing in New Delhi moments ago. And we will see US President Joe Biden getting later this evening. These are some of the issues that these world leaders will discuss and debate over the course of the weekend in the hope of a consensus or agreement that will be represented in a communique. But as you know, and as we've been reporting through the course of this year, the language around the Russia-Ukraine war has been a sticky one this year, which is why we've not yet, in any of the meetings before the Leaders' Summit, produced any communiques. They've only just been leaders' statements, and that seems to be the concern going into the weekend as well. That consensus has been arrived at, on a variety of issues that I listed, but as yet the language on the Russia-Ukraine situation has not been agreed upon, and that might continue to worry the outcome over the weekend.
How are you viewing President Joe Biden's role in the G20, given his communication to allies at this time? How would he define success?
President Biden has said two things in the run-up to this summit. One, that he was disappointed that China President Xi Jinping was not going to make it to the summit. And second, that talks and conversation are very important. And I think that goes to what the US hopes to achieve over the course of the weekend. It will fill some of the space that China has left behind in being able to communicate with members of the global south and bring about agreement on many of these issues. But it will also assert its position on the Russia-Ukraine war emphatically, I'm sure, and that will weigh upon the final communique as I described. So we're waiting to see what the outcome will be. The US president will also be doing a bilateral meeting with the India Prime Minister. That relationship has been going from strength to strength through the course of this year. So again, that's something we're watching closely.
Bloomberg's Menaka Doshi reporting from New Delhi at a critical time. Thank you for your time. Ahead of the G20 Summit, let's focus a little more on emerging markets, which will be a key issue at the G20. Joining us now is Ilke Pienaar. She's the head of emerging markets fixed income sovereign research at PineBridge Investments. When you think about the week ahead for us, what are you thinking about the role that the developed markets are going to play in relation to the emerging markets, especially at a time with such historic dollar strength?
Yes, so there's definitely a few moving parts in the week ahead, and what we've seen for emerging market debt, especially over the last 2 years, is that market access has become a problem for a lot of the credits, especially the ones that are lower rated, sort of your single B countries. So there they do need global help in the form of IMF and other bilateral partners to step up significantly to help them roll over their debt. So we will be watching the G20 quite closely to see if there will be any other projects such as the DSSI, which can assist those weaker rated EM credits.
Now, how much are the commodity swings a problem when you think about the stability here of many emerging nations when it comes to the very volatile swings you're seeing?
Even though commodity prices have declined from the peak that we had earlier last year, they're still 50% higher than the average we had prior to 2020, say the 3 years before the 2020 downturn. So we do tend to look at that more closely when we look at our raw resource exporters. So even though the year-on-year trend seems to be quite negative, in absolute terms, a lot of the companies on the ground still well supported. And even though, so you mentioned the dollar strengthening quite a bit. Yes, we've seen about a 2% move since the end of August. But when you look at it on a year-on-year basis, it's still about 6% weaker. And the dollar is really important for EMs because a lot of their debt is priced in dollars. So even though we're monitoring the recent move quite closely, we're still at a juncture where we feel comfortable when we think of it last year this time.
Ilke, what is your level of comfort around the travails of China and how that economy links to the broader EM space?
So China plays a big role. China constitutes about 50% of the EM universe, so it is a big player. However, its impact has been waning over the last number of years. We've been seeing our forecast for the Asia region, excluding China, properly decoupling from the China trajectory. For instance, where we see China growth decelerating for the next 2 years from this year's about 4.9% growth, we see Asia, excluding China, accelerating and having a growth rate that tops China. So even though we cannot ignore China, its impact is definitely less than before.
Ilke, I'm intrigued to kind of get your views on what's happening in Turkey. Erdogan, the president there, has kind of had an about face and is now saying that interest rate hikes are a good thing, having, of course, pursued this very unusual monetary policy over the last few years of cutting interest rates in the face of higher inflation. Is Turkey back to being investable?
So Turkey goes through cycles. So we see this quite often, where they almost have a point of reckoning, and they go back to the orthodox playbook. And then they do tend to throw it out of the window as we near any type of election cycle. And we are getting local elections, I think, in the second quarter of next year again. So we are listening to them closely because we think they might backtrack when we get close to that date. But so far, we are positively surprised. Erdogan, in his comments, when was it, 2 days ago, he did say that interest rate hikes are on the cards, but he also mentioned that he will not do it at the expense of growth. And that is what we all know about monetary policy. You should be willing to bring back control to your interest rate as well as your exchange rate environment at the cost of growth. And it still seems as if he's not willing to do that. But if you look at what the spreads did in Turkey, sitting at around 450 basis points, where we were close to 750 before the elections, it does seem as if it is not necessarily just a wolf in sheep's clothing, but maybe this is a turn for the better. But we are still, so if you look on hard currency side, we're a bit positive hard currency side, but local currency, that inflation is going to continue to push higher, and the FX continue to weaken. So we still have a word of caution when it comes to local currency exposure.
Ilke, I'm curious about your thoughts on China a little bit more. I want to harp on the story, given some of the disappointing economic data we've seen. The idea here that the Yuan is dropping towards a record low. But what is the ripple effect across emerging markets from the weaknesses we're seeing in China?
So when you talk specifically about the FX link, when the CNY weakens, we have a case where EM currencies strengthen against the CNY. And given that China is also seeing outright deflation in both the PPI as well as CPI, we're seeing that China is exerting a massive disinflationary wave across EM. And that's going to assist EM rate cuts, a rate cutting cycle which we think is going to be vast as well as drawn out. We're going to be in a rate cutting cycle for at least the next 12 to 18 months. On the growth side, however, so our forecast for China is 4.9% this year, down from 5.1, and then next year 4.5. So that is a slowing trajectory. And therefore, even though we still, as I mentioned earlier, Asia growth will be able to back that trend. We have lowered our overall emerging market growth forecast to about 3.3% for this year, where if you asked me the same question earlier this year, it was sitting at about 3.6, 3.7.
That is Ilke Pienaar. We have to leave it there. PineBridge Investments, thank you very much for your time at a pretty critical time here for emerging markets and the Chinese economy. Now coming up, a look at some of the market-moving events to watch throughout the U.S. trading day. This is Bloomberg.
Happy Friday. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London with Sonali Basak in New York. Now, a look at what's ahead today. President Biden landing in India for the G20 Summit this weekend. We're going to hear from Fed Vice Chair for Supervision, Michael Barr, at 9 a.m. Eastern Time. Then US wholesale inventories, that's 10 a.m. and consumer credit data later today. Sonali.
Yeah, and I want to take a look at some of the stocks we're watching in pre-market trading in the United States. And we have to talk about Apple, because that two-day slide of nearly $200 billion on those iPhone curbs to government officials. We did see some cooling pre-market a little earlier. It was reversing its declines, but right now, at the very moment, it's on track for another day of losses, though that the pace of loss is losing some steam. It lost almost 3% yesterday, 3.6% the day before, and so we're seeing a little bit of plateauing ahead of a critical iPhone launch.
It's a question as to whether or not Apple has now become a target for China. It's not clear that it has yet. And we, of course, weigh up the implications of what this ban amongst government agencies and SOE, state-owned enterprises, actually means for this company. But clearly, there's an exposure risk, and we continue to watch how that filters through the Nasdaq after 2 significant days of selling, Sonali.
It's still a long year ahead for Apple, and that does it for us today. Yeah. Surveillance is ahead. We're going to hear from Steve Major of HSBC. This is Bloomberg.